Good day, everyone. Welcome to Silverdale Bond Fund Quarterly Review, September 2018. We are grateful for your investment and value your time today to present our quarterly performance. It is your faith in us that keeps us outperforming both the indices as well as other funds. As a matter of housekeeping, all participants will be on mute mode when they join in. The brief presentation would be followed by Q&A session. Please feel free to ask your queries via video link, dial in, chat, or email. As you are aware, Silverdale Bond Fund has given a return of 2.5% for the September quarter. May I request now our CEO, Mr. Sanjay Guglani, to dwell on the performance. Thank you.
Good day, everyone. It's my privilege to welcome you to Silverdale Bond Fund Quarterly Review, September 2018. Since you all have the copy of the quarterly review, I would slightly touch upon the numbers and spend most of the time in terms of explaining the reasons behind those numbers and address your queries. Okay, so as you see from the presentation, slide number 3, we have given about 52% return to you over last 5 years, as compared to 20% by the JP Morgan Emerging Market Corporate Bond Index and 10 to 20% given by the other funds. The key thing to note from slide number 4 is that our duration continues to be less than 2 years, 1.81 to be precise, and our Sharpe ratio continues to be among the highest in the industry. More particularly, we have given a return of 2.54% in the September quarter, which coincidentally is the amount of which we had lost last quarter. So we have recovered the entire amount in terms of the September quarter. We maintained the dividend of $2 per share, which is 6.41% in terms of dividend yield. Most of the return came from the carry and a marginal amount in terms of the bond appreciation, net of expenses. In terms of the other parameters, they have been almost same. As you see from the slide number 6, we continue to maintain 75% in terms of the IG bonds. In terms of the duration, duration continues to be less than 2 years, 1.8 years. About 60% of our portfolio continues to be between 0 to 2 years in terms of the maturity profile. We have roughly about 15% of our portfolio into floating rate bonds. The slide number 7 explains to you our geographical distribution. As you know, we very dynamically manage our exposure to various geographies. In particular, I want to highlight the fact that in terms of Turkey, we have marginally reduced our exposure from roughly about 15% to 12%. We continue to be more constructive about Turkey. And as you will notice that we were one of the few fund managers, those who were able to pick up the signal among the Turkey noise. And as I shared in my CIO letter, the Turkey on the whole represents us acceptable risk-adjusted return to us. May I also point out to you that our duration on the paper which we own is roughly about 0.9 years, which continues to be on the lower side. In terms of the exposure to China, that has been principally in terms of the floating rate notes which we bought in China. And Brazil, the exposure has been in terms of Garrido, which we ended out there.
Maybe we can easily convert $5 to $8 million.
In terms of the sectoral exposure, we continue to have about
others are remaining our commission pay
financials.
As the exit flow.
And
so 8 to 10 million we can convert from the stocks and everything. So once we've arrived at some strategy, talk to the clients.
This is that our leverage we are very actively managing. very specifically, the leverage is being coming down
is not
over the period of time. And in terms of the actual leverage, it has
no trail commission, no commission. No trail commission, no trail. Because if you go through old mutual also, these people are third party commission.
You have,
so we see directly affects you.
Very important.
Temple 10 others, we don't have the terms of agreement.
And as we
since it is in the SCA, we have to go through SCA one.
Sorry for the interruption. I believe there was some of the participants, those who are not muted, and created a bit of an induction. So slide number 9 is very important, as we always maintain that the increase in interest rate would effectively increase the return of the portfolio. Very specifically, the Fed rate hike of 75 bips has increased the portfolio YTM by 1.59% from 3.95 to 5.54, and increased the leverage YTM from 6.72 to 10.07. So this is what we always maintain, that over a period of time, a short duration leverage bond portfolio gives you higher risk-adjusted returns than most of the equity portfolios, and does very well in terms of increasing interest rate scenario. This gives you an overshot in terms of what we do. 70% times they give a positive return to you. This gives you overview in terms of the assets which we manage, which we always maintain, that we keep it a very conservative approach. As you notice that it's about $500 million of assets which we're managing across out there in this particular strategy. Slide number 12 explains to the fact that we have outperformed not only the indices, we have also outperformed the peer group very significantly. To be the exact number, till September this year, we are down by 0.67%. The JP Morgan Emerging Market Corporate Bond ETF and the underlying index is down by more than 2.5%, and while the other funds have been down between 1 to 9%. To summarize, in terms of the performance, we have outperformed our peer group in the industries. We have maintained the duration of less than 2 years. We maintain the dividend of $2 per share per quarter, accumulating to $6 per share, which we paid this year. Very importantly, for the people, those who have raised this query, in terms of the cash flow for purpose of dividend, let me point out that the coupon is approximately 5%. Given that we are leveraged 2 times, 5 into 3, 15% is approximately our cash inflow, while our outgo is only 6 odd percent. So very well covered in terms of the cash flow. In terms of sustainability, again point out to you, given that my leverage YTM is 10%, I'm paying you 6%. Yes, reasonably able to maintain the cash flows.
Yeah, focus is one thing.
Again, reiterate, there is no change in the strategy. We continue to be investing in bonds, short duration. To summarize, in terms of the interest action, the Fed rate hike of 75 bips has increased the fund YTM by 1.59% to 5.54%, and the leverage YTM by 3.35% to 10.07%. The slide number 14 summarizes what we have spoken, and I would like to highlight this in this 2 important portions. Number 1 is that our proprietary fungible cash flow model continues to drive our outperformance. So we had 14 cases, 14 cases of upgrades to buybacks in the year, which is added alpha to our portfolio, our returns. And as I mentioned to you, a return of 10.07% for a portfolio duration of 1.81 years is fabulous by all standards. With this, I conclude the presentation. Happy to take questions specifically.
Hi, Sanjay. It's Hashim Shahabi. How are you? Hello? Sanjay, can you hear me?
Sorry, could you
hi, Sanjay. It's Hashim Shahabi. Can you hear me?
Yes, could you repeat the question, please?
Yeah. So, Sanjay, the only concern is with the leveraged, if we're entering much more volatile times, right? You know, and I think this is something we've addressed before, but we're cognizant, obviously, because of the leverage. You know that if there would be a situation where there may be forced selling in the portfolio, and I was wondering if you could address how you would handle that. I understand, of course, that the optimal yield to maturity is about 200 basis points or 300 basis points above the leveraged yield to maturity. So I guess there's some headroom there. But I guess the question is, you know, in a situation where there's forced selling or there's downgrades and at the same time outflows from the funds, how you would handle that situation?
Okay,
thank you.
Thanks for the question. Let me take you to the new 2 slides which we put in the presentation, which is the new slide number 10, which is on the screen right now. Hope you can see. Yeah, fantastic. So as you notice, we have been extremely prudent in terms of the management of the leverage. So we always maintain a sufficient amount of headroom. Just to give you a historic perspective, since about 2016 to 2017, we were maintaining a headroom of about 5-7%. We increased the headroom to 10 to 15%. What does it mean is this? A 1% increase in the interest rate hike with a 2-year, say, duration would impact 2%. Since we are leveraged, you make it 4%, make it 8%, doesn't matter, because you have 10% headroom with us. So that's the first and most important mitigant you should be aware, that with 10% headroom, more than 10% headroom, we are reasonably safe and secure. The second thing to keep in mind is that given a short duration, you know, 60% of our portfolio matures in 0 to 2 years, we would have, for example, in this quarter, about 3 to 4% of portfolio maturing, right, which again adds to the headroom. Point number 3 is in terms of the coupon inflow, given that we have 5% coupon, 2 times leverage, 15%, there again 15% of the equity amount which is flowing in, which again adds to your leverage. Point number 4 is that we make sure that any given point of time, we do not take more than 35% of hard limit of our loan from one particular bank. And the reason why we do that is because, as you know, many banks would change leverage from time to time, and we don't want to be caught on the wrong foot. So even if technically speaking, a bank was to withdraw limit to us, let me clarify to you, I'm not talking about withdrawal on a particular country or security, which is normal. I'm talking about the bank withdrawing is lending altogether. Even in that case, within 48 hours, we should be able to move our securities and take care of it. Next point is that we agree with you that, you know, mark-to-market losses stroke lending value would change, but also keeping in mind the fact that given a short duration, as we're riding the duration curve, we are adding to a certain amount of alpha. And so that again gives us a certain benefit in terms of to be able to manage it. Is it okay? You want me to dwell more on it? Let me know.
No, that's good. Thank you. Thank you for all those responses. I guess the question is, have have you been in a situation where a bank overnight just withdraws lending entirely? Has that happened?
So let me put this way around, yes and no. Would the banks change the lending value? Absolutely yes. I can vouch for it. Every bank I've seen in the last decade and a half changes strategy every 2 to 3 years. So we do see changing in the lending value where they say, oh, we don't like China, we don't like Russia, we don't like Turkey, we don't like Brazil, and so on and so forth. So we have seen that it happens all the time. I don't remember a single year where has not happened. So we're very cognizant of it. And between you and me, I mean, often it doesn't matter beyond a point. It's okay. It's a bit of a pain that we need to do some reallocation of the assets to securities. Doesn't matter. Second question is that does it happen ever that bank has stopped the lending limit altogether? The answer is yes and no. The right answer is no. They have never stopped the lending. But we have seen situations where the bank has told we want to exit the business. Example, we used to be banking with Barclays Bank about 5.5 years ago when we started the fund, and they decided to sell part of the business unit. I said, hold on, I'm not going to go to an unknown lender for me. So we decided to close our accounts with Barclays. Same thing happened with ABN AMRO Bank. So we have seen twice this thing happening across out there. Currently, as you know, our biggest banker is Credit Suisse, Julius Baer. I don't think they will do it. But should they do it, we are reasonably prepared to be able to move our assets.
Thank you very much.
Rajan, please go ahead.
Thank you, Sanjay. Actually, this is just a follow-up on the same point, Sanjay. Given that you'll increase the exposure to emerging markets, which I guess in a sense is the right thing to do, and as a side note, congratulations on the performance this quarter. I guess what is kind of really difficult circumstances, you guys have done a fantastic job. So congratulations to you and the team. The question really was with this increased emerging markets and the fact that risks are not really, I mean, the bigger risks that are starting to come are now political risks. So whether you take Turkey, whether you take Brazil, really it is political risks. And once you come to political risks, to come back to the question, banks may actually freeze lines or withdraw lines completely from the country purely from a political point of view. And have you modeled whether 10% is adequate from your perspective, or if you needed to have slightly more headroom, would you start to put some buffers in place to deal with the increased political risk in the current environment?
Okay, so let me see. First is foremost that the banks withdrawing lines of credit for a particular country is absolutely always done. So to give you a color to you, even this year we know certain banks had withdrawn credit for securities from Turkey. None of our bankers did it, but we were acutely aware that that did happen in the market. Earlier we saw the same thing happening in Russia when the first Russian sanction came. And in the interim, we also saw it happening into China to some extent, where most banks then and even today have a strong restriction in terms of how much maximum Chinese exposure we can take. So to answer to your question is that, number one, yes, we are aware of it. We face it every single year in some form, every time. Second question was that, do you think 10-15% which you're maintaining is adequate? The answer is yes, that is what we feel it is adequate, but with one important caveat. For example, when the Turkey problem happened, we did two-tier analysis. One was to look at Turkey and see how much is hype and how much is a fact. And therefore, we went deep into it to understand that where the Turkey stands, what of the people numbers they're talking about, the actual numbers, and we were convinced that we don't think Turkey was a dead case. But from prudence point of view, we did, for example, a few things which I mentioned in my CIO letter. A is we reduced the exposure to Turkey. B is that in terms of the Turkey exposure, we started reducing duration further, right? So we did take steps in terms of what we're doing. We went one step further in terms of assuming that the leverage on Turkey would be zero for us. So when we did our internal computation, we had assumed the leverage to be zero and we ran the fund. So at any point of time, if any bank would have removed the Turkey, I'd like to be more precise, if all the banks would have removed the leverage from Turkey in our portfolio, we would need to take zero action because of that particular incident. So we do take proactive steps to make sure that we are adequately covered. But yes, if something completely a black swan event happens, for example, if the bank says, look, I'm not going to finance US or I'm going to finance China, would it be impacted? Potentially, yes. But I think in what we have seen historically, we don't think it's going to happen overnight. But that I should admit that a black swan event by definition is a black swan event.
Thank you very much, Sanjay. Much appreciated.
Hi Sanjay, I'm Shravan this side. Can you hear me?
Yes, I can hear you, Shravan. Thank you.
Well, I have a question regarding the interest rate and bond market as a overall. Well, as you always say, the interest rate is only a positive news for our bond fund. How would you, elaborate a bit more that see an YTD bond market hasn't done anything. Yeah, even the near term possibility is so. So how are you looking at this scenario, and when when in your views you see the pickup into the bond market? Of course, I understand duration is low, the YTM is attractive, but still there's a concern about bond market as such overall.
2 points. Point number one, if you look in terms of portfolio, as you notice, the transmission of the Fed rate hike has already happened. So when people talk about rate transmission not happening and the bear flattening, they are partially correct because they are looking, for example, the long end of it. So if you're looking at 30-year treasury, obviously it doesn't move. But when you're looking into short-term zone, which we are working in 0 to 2 years, we see the impact already happening there in the market. So it's not something which is not taking place. So if you look into our portfolio itself, as I mentioned on slide number 9, 75 bips increase, the Fed rate has increased the portfolio YTM by about 3.35% on leverage basis. So the impact is already happening. So let me also clarify this portion. Now, just be careful because I'm trying to simplify to make a point. So if you look in terms of the slide 9, you will see the bottom of our curves were in December. Until June, you saw a basic curve going up. The last quarter was the first quarter, here relatively lower or rather flattening happened. And when the flattening happened, you saw the return had spiked up. So this gives you a simplistic view of explaining that when the market is already priced in, the portfolio pricing also happens. In 2017, it used to take about 2 months for the pricing to happen. Now in less than a month, it happens. What happened earlier this year in Q2 was where the pricing had beaten the even Fed rate hike. So the portfolio got repriced before the Fed rate hike happened. And to explain this, I have a very interesting slide. Let me see if I can get you the slide. Okay, give me a second. I'll give you the slide which explains to you how this portfolio is happening, which is a slide which explains to you the how the LIBOR 3 months is facing versus Fed rate hike. So what you notice is that the previous 2 rate hike didn't impact the LIBOR. I repeat again, the previous 2 hikes, not the last hike, previous 2 hikes didn't impact the LIBOR. So the point of the LIBOR was already priced in the rate hike before it happened. So I want to show the slide to explain this point, which hold on to me. This is the wonderful presentation for people, those who are aware of it. Yeah. So as you will notice, so when you notice this this where you're seeing my red dot is basically the Fed rate hike. What you're seeing, the green line upper boundary, is the LIBOR. So what you notice is that when in the month of December, the LIBOR already started moving up very severely, very steeply, and it resulted in what we saw in the first quarter till March. So the LIBOR increase from almost 1.6 to 2.4 happened in the first quarter of this year, while the Fed rate hike took next 3 quarters to happen. You see the red line? The red line shows the transition. So it's now when, because the market is priced in 3 rate hikes, market has not priced in the 4th hike completely. So what is happening now is that before the 4th hike coming in, market is already trying to price in the potential rate hike. The takeaway to you from this slide again, the same point which I'm mentioning, that it depends on the portfolio composition. So as in the first quarter this year, the portfolio had already taken into consideration the rate hikes. So to summarize, a short duration bond fund, the rate hikes is not a critical factor for the purpose of determining in terms of the performance.
Mm-hmm. And when do you see the pickup in performance as such in your view? Of course, it's hard to predict, but still, want to know about your thinking.
Beg your pardon, pickup means?
Pickup in the performance.
So, okay, what I'm expecting in future, is that question here?
Yes, and say this year performance net returns or next year performance net returns. Your expectations, of course, is it the 10% that we can realize?
Okay, so mathematically speaking, 10% YTM means, of course, you get 10% for the next 1.8 years, provided we don't take any action. Any action basically means that we go to sleep, namely we do not reinvest the coupons, we do not reinvest the maturity. So the answer is that yes, you would get 10% provided we don't do anything. In reality, what will happen is you'll have the mix of two. On one hand, you would have that 10% coming to you, partly in terms of capital appreciation and partly in terms of carry. Question: how much will be carry and how much is capital appreciation? Answer: in case there is no idiosyncratic events, you should get a capital appreciation which is basically reverting to mean, which basically means you should get about 2.5% capital appreciation, right? And the balance should be carried. But because of idiosyncratic events, this capital appreciation could move away from the mean, continue to be moved away from the mean, which is around 8%, and that's the return you will get across. So if your other question is that, what will be the key constituents going forward next year? Well, there is no, we don't think any great change in the strategy. There will be some technical factors which will help the fund perform better in Q1 next year. For example, the sheer fact that Q1 always sees the new money coming in, and therefore we see appreciation happening across there, because of the fact that a lot of the floating rate securities which we have, the ceilings which we have, would get repriced in Q1 next year. So the 5-year ceiling which we did had a reference of 5-year CDSs, etc. Now it will be referred to 3 years. So by definition, by technical reasons, you will get an uptick also on the Q1 of next year.
Mm-hmm. All right, yeah. Thank you.
My pleasure. Any other questions you have?
Sajay, this is Rajan again. What do you see as the risk over the next 4 quarters for the fund? What would be the 2 biggest concerns that you have?
Anything specific you want me to highlight?
No, Sanjay, I'm just looking at it from your perspective. What is it that you're looking out when you look out into the next 4 quarters? What would be the areas of concern that you
So we can.
Okay, so let me put this around. In terms of the going forward, what is going to happen is two important things. One, of course, is the I would say quasi black swan event, because we do not know what's going to happen. Namely, in terms of the British exit, that looks to be a very significant risk to us because we have less than 1 month to go. We are hopeful that some deal will be cracked through, but if it doesn't crack, then we would have a huge, huge issue worldwide. People are grossly underestimating the repercussion it could have for a hard British exit. There's a big, big issue which we are concerned, and we do not know, and nobody knows in terms of what it means. The other thing which we are cognizant is in terms of the fact that the geopolitical factors will become important, and in that context, we have two key things which we are worried about. One, of course, is the what happens in the Middle East, which is a very, very volatile place to be in. The trade spreads which we are seeing in the Middle East are crazy. I say crazy because the short-term price which the banks are willing to take a deposit is higher than the rates offered on the Middle East bonds, which is crazy because it means there's a gross mispricing happening in the market. That's something which we have to be aware of. The second question was the China portion. So while in terms of the impact on the trade would not be significant as a point of time, but we are also aware that it spiral out of control. Today, what people are not knowing is that the amount of tariff which US is giving China almost mitigated in terms of the depreciation of the Chinese. So to some extent, it's been taken care of. But the problem is not in terms of big picture. The problem is in terms of the macro. The industry would get very vastly impacted, and the worst problem would be in terms of real sheer, implementing it in terms of the tariffs on various items. Given the fact that you may end up having certain products which are basically assembled, manufactured somewhere else and only assembled in China.
I'll give you my timing, so we can meet today here and continue around 0 if possible.
Raju, is it okay? You want me to elaborate more?
Sorry, Sanjay. I mean, Jahangir unfortunately keeps coming in and out, so I guess he talked over you quite a bit, so I lost a lot of what you said. But that's okay. I don't think you should repeat it. I get the two broad points that you're focused on, and really appreciate the Brexit issue and the whole geopolitical situation, specifically what's happening in the Middle East. So thank you for that.
And just to add you to one more point, I'll give you the big macro picture which we are worried about in the global scenario. Coming to macro pictures, so let me clarify to you. Number one, while we do not think Turkey is a Christmas turkey to be rejoiced, but we also believe Turkey is not a dim duck to be thrown. So we see a lot of value in Turkey, but we would need to be very, very careful there. So we continue to monitor very closely. We do not see a big problem, but we are careful there. We are also careful about Brazil. We believe that there's value in Brazil today, but given the history of Brazil's dictatorships and the inclination of the income in the potential president of Brazil, we are careful there in terms of what happens. So we need to be careful, but yes, there could also be a lot of opportunities. So we are in constant touch to make it happen. In terms of Mexico, we've seen basically a certain amount of problem there in terms of the fiscal deficit sector out there, and that's something which we need to be cognizant. We we don't see much value there in terms of the Mexico issue, but something which we need to be careful about. In terms of China, we are seeing China a huge amount of opportunities, given the fact that there is a clear distinction happening between the various segments of China. Let me give you this point to you. In the beginning of the year, almost all Chinese credits were being quoted the same spread. In the middle of the year, we saw a clear distinction between LGFCs and SOE. Subsequently, we have seen the difference between SOE, which are critically important, and SOE, which are not important. What's happening lately is, if you notice, in the last 2 weeks, 3 weeks, and which we've seen earlier also, which is basically that many of these Chinese companies are now being quote unquote forced to come to the market not because they require money, but because of the fact that they have the permission from the government to raise monies. So they wanted to come to market to raise monies, and they realized that they can't raise money at the price they expected to, and they're withdrawing the issues. Something which was practically unseen till about a year ago. So we are seeing a lot of interesting things happening in China. We believe China will give a lot of opportunities, but of course we have to be careful there. So that's in terms of the country-specific thing to give a color.
Many thanks, Sanjay. I really appreciate that. Thank you.
Can I ask you, Sanjay, are you seeing much value in European cocos, or is that something that the fund has just not looked at all? Or can you comment on that?
The rule of thumb is no, we do not look at cocos, but there could be certain exceptions. So let me put this around. If it was something like a non-Basel compliant, happy to look into it. If something which is going to be called in next 1 to 2 years, happy to look into it. Caveat is that under the new EU laws, as you know, they cannot call the bond for sake of calling it. They need to have reasons to put the cost out there. Our interest rate cannot be only reason to call. So we are cognizant of many things which goes with it. So I would put this around. Answer is no, we don't like cocos. There could be exceptions, and that has to be idealistic about each particular name.
Thank you.
Sujendra, yeah, please go ahead. So should anybody has other questions, please let me know. Of course, you are welcome to get in touch with us through emails, and we try to give more details to you in terms of the query you may have. Should there be no other questions, I just like to thank you for your time. I appreciate your and really value your support to us. I'm delighted to share that we are among the rare funds in the world, those who have been able to get net inflows thanks to you. As you're aware, whether it is basically or Imco or Janus Henderson or Fidelity Franklin, all of them lost between 25 to 40% of the assets. We are delighted to share that we have increased our assets in this year, and thank you very much for your support. We are committed to give you the best possible risk-adjusted returns, and we try to provide you the best which we can do. Let me now hand it over to Mohini for the closing comments.
Thank you so much, everyone, for your time, and do feel free to write into us for any queries that you might have. Thank you so much. Bye-bye.